Well, good evening, everyone. Today we'll be looking at management information. Under management information, we'll be looking at cost segregation and estimation. We'll be looking at two major content under this broad topic, which is the introduction to segregation and the method of estimation. Um, when we say the introduction to cost segregation, the total cost associated with a business or part of a business, for example, is the production line. For the sum of fixed, for the sum of the fixed cost and a variable cost, in other words, the total is semi-variable in nature. If the total cost can be divided into fixed costs and variable costs per unit of output or unit of activity, then a formula for the total cost is that is, if you remember in our last class we talk about the cost function. Talk about the cost function. I give us the formula for total cost. Now I'm also repeating it in this topic. Now the total cost will be y, which is also tc equals a in this context is what is fixed cost plus bx. Then b b is our variable cost per unit of output or unit of activity, while x is the number of units of output or the volume of activity in the period. Now what is cost function? So cost function, the term cost function is also used to refers to a regression equation that describes the relationship between a dependent variable and one or more independent variables. The cost functions are normally estimated from past cost data and activity levels. Now, the cost function is just is is your linear equation, which is your straight line equation, which is also your total cost. So your cost function is the same thing as y equals a plus bx. Now, cost estimation method. That the method used for cost estimation. What are those methods used for cost estimation? Now, the following approaches to cost estimation will be examined. So under this topic, we will be looking at this different approach or method to cost estimation. But out of these five method or approaches, um, the last two, which is high and low method and least square method, uh, these two are the major method in which ICANN will test. These are the major method ICANN will test. But out of these two, I will emphasize more on high and low method. But high and low method will be used in our subsequent topics. These approaches differ in terms of the cost of undertaking the analysis and the accuracy of the estimated cost functions. They are not mutually exclusive, and different methods may be used for different cost categories. So all these methods, they have different ways of using them. They have different approaches whereby you use them. So you cannot use all of them for a particular equation. Now let's talk about the engineering method. Now the engineering method of of analyzing cost behavior are based on the use of engineering analysis of technological relationship between input and output. Now, for example, work sampling and time and motion studies. The, the approach is appropriate when there is a physical relationship between costs and the cost driver. Between cost and the cost driver. The engineering method is used for estimating costs of repetitive processes where input and output relationship are clearly defined. This is where they clearly define the input and the output of the production line. So we can use the engineering method. The engineering method is not restricted to manufacturing activities. So engineering method is not only restricted to production line or manufacturing activity. It can be applied to well structured administrative and selling activities such as the typing, invoicing, and purchasing. It is not generally appropriate, however, for estimating costs that are difficult to associate directly with individual units of output, such as many types of overhead, since these items cannot easily be directly observed and measured. Now, when you are using engineering method is only used where you have different um, items, different overheads. So you can use engineering method in such cost estimation and analysis. Now, let's look at the inspection of account. Now, this inspection of account, that accounting record method. Now, the inspection of account method requires that the departmental manager and the accountant inspect each item of expenditure within the account for a particular period, and then classify each item of expenses as a whole fixed, whole variable or semi-variable cost. Here the accountant is the one that now this is more subjective because the accountant is the one that will classify the cost, the expenditure into its variable and its fixed and the semi-variable expenditures. A single average unit cost figure is selected for the items that are categorized as variables, whereas a single total cost for the period is used for the items that are categorized as fixed. For semi-variable items, the departmental manager and the accountant agreed on a cost function that appears to be the best describe the cost behavior. Now, for this account inspection method, it's always between the departmental, which is the functional managers and the accountants. They they want to sit down and analyze each cost, each overhead, each expenditure into its variable and its what its fixed component. So then they want to total them, and they also compute the variable cost per unit of all the variable costs. Now, the graphical or scattered graph method. The graphical or scatter graph method. Now, this method involves plotting on a graph the total cost for each activity level. The total cost is represented on the vertical axis. The total cost is represented on the vertical axis, and the activity levels are recorded on the horizontal level. Now, a straight line is fit to the scattered of plotted points by visual approximation. Now, that means in a graphical method or scattered graph method, there will be the y-axis and the x-axis. Then you go to plot the cost alongside the activity level. Then all those points are what the graphical method. Then there will be a straight line um from left to right, which is like a supply curve. Now, what is the limitation of this graphical method? Now, the limitation of the graphical method is one. um Drawing the line of best fit can be quite subjective. Remember that we said in the graphical method, you're going to draw a straight line which is like a supply curve. That line might be subjective too. They might indicate a relationship where there is none. So when there is no relationship, it will tell you that there is a relationship, which is the graphical method. So it does not shows an accurate relationship. Three, they can just show relationship between only two variables at a time, but the issue under study might be more complex than this. Now, mostly the graphical method is always to shows the relationship between two different variables, used for to show relationship between two different variables, relationship between two different variables. Now, the fourth, they might lead to incorrect conclusion if there are only few data points available. Now, if there is no adequate data point, because if there is no adequate data point, it might lead to an incorrect conclusion and what recommendation. So the other method that we will look here is the high and low method. The high and low method. The high and low method consists of selecting the 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 period of highest and lowest activity and comparing the changes in costs that result from the two levels. Now, the IRA method um is a method in which we should lay more emphasis on, where we should understand more better, because this is the method I can we test. So out of all these four methods, we should understand this IRA method very very well. Now, this IRA method, how does it work? The IRA method, we go to identify the highest activity level and the lowest activity level, not the cost. Now, it only emphasize on activity level, not the cost. Now, under the higher activity level, you will look at the activity level and the corresponding cost. Why the lowest activity level and the corresponding cost. Then look at the changes. That is how you derive our high and low method. Now, the method itself. Now, the method, which is the method in which high level method can be computed, we said we have different steps. Now, this step, when you understand this step, our questions and solution will be very easier for us to understand. Now, method one, which is step one, take the activity level and the cost for the highest activity level and the lowest activity level. Two, two, two. The variable cost per unit can be calculated as the difference in the total cost over the difference in the number of units. Then the four, having calculated a variable cost per unit of activity, the fixed cost can be calculated by substituting in one of the cost expression the difference between the total cost at this activity level and the total variable cost at this activity level. Then the four is what? To construct the total cost function. Well, the cost function is what we said before, which is the y, or which is tc equals to fc, which is the fixed cost over plus the variable cost. The variable cost is b times x. A company has recorded the following costs in the past 6 months. Now let's look at this illustration to buttress our explanation so far. Now look at this illustration. We have different months. We have months January to June. We have production units for January and for the June, and we have the total cost for January and June. Now you are required construct the cost function. Construct the cost function to calculate the total cost that should be expected in July if output is 5,800 units. Now once you calculate the cost function, now we have to follow our steps. Now in follow our steps, the first thing is to identify the highest activity level. Looking at this production unit, the highest activity level is 8,200, which is match. So our solution will now be the production units and the total cost. Now, using the high and low. Now, the highest activity level is March, and the lowest activity level is April. Sorry, it's not. It's the lowest activity level is January. Is January, which is 5,800. Now, you have to bring the highest activity level and lowest activity level side by side. Then, looking at the difference between the highest activity level and lowest activity level, you have the changes. Now, your variable cost per unit is a change in cost over change in activity level. Change in cost over change in activity level. Change in cost over change in activity level. Now, the change in cost is 8,400, while the change in activity level is 2,400. When we divide 8,400 by 2,400, we have 3 point we have 3.5. So our variable cost per unit is 3 naira 5 kobo per unit. Now, after driving our variable cost per unit, to know our to construct a cost function. Now, our cost function is TC equals FC plus BX. Now, our cost function can be calculated using the highest activity level or the lowest activity level. Now, let's use the highest activity level, which is 8,200. Now, we are giving that the total cost for the 8,200 is 48,700. Then we don't know our fixed cost. Now, our variable cost per unit is 3 naira 5 kobo times 8 our number of activity, which is 8,200 units. Now, when you multiply that together, we have 28,700. And our fixed cost will now be total cost minus our variable cost. Then that will give us fixed cost will be 20,000 naira. And our cost function is, which will be TC equals FC plus V plus BX, now equals to our total fixed cost is 20,000. Then our variable cost per unit is 3 naira 5 kobo, then times F. Now, what is our total cost where X, which is number of activity or number of production units, is 5,800? Just slot the 5,800 into your cost function. It will give us our total cost. That's our total cost. Now, let's look at this illustration 2. Illustration 2. A manufacturing company has budgeted to operate for 110,500 hours in the year, which is 85% capacity. Now, the hours for operation is 110,500 hours, but the hours is under 85 capacity. Now, the expected total cost for the year is 615,200. Why the management accountants has also estimated that at 100% capacity, which is the full capacity, the total annual cost would be 662,000 naira. Now, this question is a little bit technical, different from our first illustration. Now, you are told that required that using the high and low analysis, estimate the variable cost per unit or per hour worked and the total annual fixed cost. Now, Now, this question is that when you look at this question, you find out that we are giving the activity level, which is the production hours for 85 capacity, which is 110,500. We are giving the cost, and for the 100% capacity, which is the 100% of activity level, we are not giving that the actual activity level, which is the production hours. We are giving the total cost, which is 62,000. But now what we are looking for is the hours for this 100% capacity. Now, the first thing we have to do is to calculate the hours for the 100% capacity. 100% capacity. Doing that is that we have to gross up our 85% capacity. So when you are giving such different capacity, you want to look for the total capacity. You also need to gross up the capacity given, which is not the full capacity. It will be the hours of that capacity over the percentage. But by the time you put your calculator, you find out that the hours is 130,000 hours. Now, the hours is now our what? High, our highest activity, which is 100% capacity, and the cost is 862,000. While the low capacity is 110,500. So the change in the hours and change in cost we give us this. The available cost per unit, which is 2 naira 4 kobo per hour. Now, to calculate our total fixed cost will be total cost minus what? Our variable cost. Now, here I'm using low because the other time I use high, so you can also use low. Using low or using high, you must arrive at the same fixed cost, because you should remember that fixed cost in our previous class, fixed cost does not vary uh, directly with changes in activity level. So fixed cost remains constant, though it's not always the case in all situations. We have some situation whereby we have what we call a step up cost, a step up cost, a step up cost, a step up cost. Now, we can solve this as an assignment in our next class. In our next class, we will be in our next class we will solve it. In our next class we will solve it. In our next class we are going to solve it. So we have high and low. High and low can be calculated for different situations. The first one we calculated is for high and low for forecasting. I mean, if you want to forecast a separate or a future activity level, a future activity level. Now, the other high and low we have to compute, we will look at is high and low when there is a step cost, there is a step up cost. Now, as we said before, we said a step up cost is an incremental fixed cost. A step up cost, we said fixed cost will remain unchanged, remain fixed in a particular activity level, but after that activity level, the fixed cost will not increase. The fixed cost will what? It will increase. Now, once the fixed cost increase, the difference between the previous fixed cost and the new fixed cost is what? A step cost. A step cost. That step cost should be treated as follows. Now, say the high and low activities can also be used when there is a step increase in fixed cost between the low and the high activity levels, provided that the amount of the step increase in fixed cost is known. If if the step increased in fixed cost is given in naira value, if you give it in naira value, the total cost of the high or the low activity level should be adjusted by the amount of the increase, so that the total cost for the high and the low amount use the same fixed cost. Now remember that we said when there is a step cost, now your highest activity level and low activity level might not have the same fixed cost. So for them to have the same fixed cost, you have to subtract your um your step cost from the activity level that is beyond the fixed cost activity level in order to arrive at the fixed cost for the high and low, because our high and low must have the same fixed cost. Now what is the method for this step cost? We said the method is one, take the activity level and cost for the high and the low activity level. So this almost the same thing with our previous step. Two, make an adjustment for the step in fixed cost. Now the step in fixed cost, you make an adjustment for that. How to do that is by one, add the step in fixed cost to the total cost of the low level of activity, or deduct the step fixed cost from the total cost of the high level of activity. Now when you are given a step fixed cost, it means that in your low there is no step fixed cost there, because in your low because in the low there is no step fixed cost, because it is still within the range of fixed cost. Your activity level still within your fixed cost. But in the high, if they are above the range of activity of fixed cost, there will be a step fixed cost in your total cost. Now for you to do your high and low effectively, is one, is either you add that step cost in the total cost of the low, then use that to calculate your high and low. Now this step two, which is the make an adjustment for the step in the fixed cost. So as I said before, it's either you add your step fixed cost to the total cost of your low level of activity, or you deduct it from the total cost of your high level of activity. That high level of activity that have include the step up level activity. So from the cost you deduct the step up cost from it. So after you use it from it, then you now compute your high and low, then calculate your variable cost per unit. Now having calculated your variable cost per unit of the activity, the fixed cost can be calculated by substitution into one of the cost expressions. Now there is step five, is that construct the total cost function of the unadjusted level. Then before you adjust for the step up cost, you have to construct your total cost function, which is your uh, tc equals tc equals your fc plus your variable cost per unit times your activity level. Now when you do such, then when you calculate your total cost function, then you now adjust the level by revising the adjustment to the fixed cost. That means when you are asked to compute the total cost for a particular activity level, that is want to forecast for a particular level that is above the fixed cost activity level that warrant a step up cost, then you now have to add back your um add back your step up cost to your total cost. That means your total cost will now be your tc equals your VC plus your FC plus your step SC, which is step cost. This question we will solve it in our next class. So our next class we'll look at this question, then we'll solve it together. Then we'll start from this question in our next class. After this question, we'll now go to high and low, where there is inflation. High and low, where there is inflation. How you are doing for high and low where there is inflation? And also look at your step up cost, whereby it's not a cost, is in percentage. We'll look at this question before we now go to the high and low where there's inflation. Then we'll look at your regression analysis, and we'll look at correlation analysis. So please let's endeavor to solve this assignment. Let's try to and solve the assignment. Any question will pop it, we ask the question via our WhatsApp group, and I'm going to reply to us. Thank you. Good night.